free to seek advice from my colleagues and myself on the topics discussed. And should you ever require any clarification, you can reach us through email at futures@phillip.com.sg or our customer service hotline at 65380500. So we will do our best, of course, to advise you on trading accordingly. Okay, without further ado, let's go in. So this is the presentation agenda. The narrative is quite clear, 4 segments. The first will be a market recap on what's happening in crude oil, to give some of us familiar with oil fundamentals, right, a head start. Before looking at, of course, market overview, some key performance indicators in 2019. The third segment will consist on market assessment, technical analysis on oil prices to give you an idea of support, resistance, and some of the trends. And lastly, of course, trading oil 101. So how do we actually trade crude oil and its products in the markets? So without further ado, I'll go into the first one for market recap. So actually, how did oil prices perform in 2018? So we saw in the first half of 2018, right, there was a market rally. So the WTI actually rose from point in January, about a 25% rally in the first half. So of course, there are fundamental factors behind this, but what are some of the key factors that initiated the current rally? So if we see, this is I've condensed actually 4 key points. The first would be OPEC plus production policy. Actually, OPEC members were highly compliant towards established output parameters that were imposed in the December's meeting in 2017. And also, we saw that Venezuela, Libya, Nigeria, Angola suffered from persistent supply-side weaknesses and production capacity issues. So this helped to actually lower production levels and output levels on one part of the paradigm. And also, in lieu of political risk, we saw that the States Senate had able to read on Iran. Then the pushing sentiments, right, on the supply squeeze. The most key factor is a consistent decline in OECD commercial stock. So entry levels actually fell to below the 5-year. So the recurring themes, right, that I would maybe let our investors understand more about oil fundamentals and technicals and how you can actually take better or take a view, exclusive view of the market. So okay, so now this is the key point, what we are all interested in. So in be rangy conditions in the marketplace. So this is largely due to OPEC plus, right? They decided to increase production levels, US political pressure from the States. So in US production in the Permian Basin as transportational capacity issue, an increase in output. But now for the fourth quarter, actually to be more precise, mid-October, right, it high over here at about $76, right, before which actually, and when it broke the 62 and $62 mark, right, there was a as the market officially entered the bear. So before key factors behind these steep prices. Okay, if we look at in this caused by supply in the market, we saw record high volume trading, very overall bullish sentiments from the marketplace. We can see also the spot month was actually very strong, and the prices of the spot month was very strong. And the market was largely subsequent. The IMF started to reduce economic projections beyond 2018. Tighter monetary policies from rising, right, and effects on the world. IEA and the global oil demand, thereby fueling talks of prospects and potential of a weaker fuel demand and crude oil marketplace. Sharp correct correction on the marketplace. Before we saw, just a minute. So, okay, sorry, pardon me. So before we saw, right, huge sell-off as well in the global equities. So with this actually huge equity market slump, there was a huge contagion effect. That probably pushed prices to about 60, along money managers' cautions, long liquidations. But the real key issue, right, which caused a huge crash into the 50 marks we saw yesterday, was when sanction waivers started to kick in, and the markets has largely shifted. There was a lot more confidence in the potential of supply increase, and we are officially in. So, from a technical perspective, actually, where do we see quarter, and also what are the key hampering it? So the first point I would say is that we actually is very bearish on the current prospects of oil. It's quite us because we have been bullish for oil since the start of 2018. But fundamental and technical perspective, we can see that market. So the first key point that will largely keep oil prices very controlled is that the effects of this UN-Iran sanctions in waiver 80-day 8 countries going to be bearish. Has a lot of bearish effects because we can see that China, we have seen Asian buyers actually starting to make purchases from Iran. Has factored in for this, and also the economic projections beyond 20. This has actually clouded the investors' outlook and market confidence. Given prospects to weaker future, constant actually on this agent largely from economists. So even for US, cover quite a bit. And one of the key factors that we have seen is Permian Basin rules will continue into 2019 at least. But we have some positive, but he has yet to deliver for strength as OPEC Plus pledges to revert back to output cuts in December. So from so I have to cover this as well. So this is quite important, right? It's a last minute inclusion, but we have seen there's a shift in the commodity curve in the recent term, actually in mid-October, right, where oil futures actually to contango. Now this is quite important because for those of you who do not understand, right, when the calendar spread right is in contango, it's a very natural working. It was in backwardation, where it reflected that there was much tightness in the market. But now the market reflects weak fundamentals, and it might show that and supply fundamentals are not as for upward surge in oil price. So this is one of the reasons opine that there's a structural shift for oil prices. So technical analysis, assessment, actually, you see there's actually bear movement, a massive sell-off, actually, huge candlesticks, weakness actually. Support soon has failed from several occasions. So in our perspective, right, it doesn't seem to be for now. So it looks like even for those of you who believe that it's slightly over, a little respite from to $50 before it might find some good support. So that's why in our perspective, right, there's very strong potential in the current term. But what is more likely the point is that in the end of the trade between 55 to we postulate for a bounce as market slowly regains confidence, kicks in with postulated supply cut sanction. OPEC Plus kicks in with output and production limits. And also, hopefully, if the member follows, we have to check all this. So, yeah, so key resistance looks to be at the 59.47 mark here, and key support will be here. So I think investors would do good. Oh, by the way, this is the WTI chart, a weekly chart. Okay, some of the key variables for oil in the fourth quarter I've added this, so you might before me. So the first would be, of course, the OPEC meeting. How aggressive is the output cuts? Will the US actually, or will Russia and Saudi Arabia actually decide to defend market US instead of cutting prices? So I think this is one. We have heard talks that it might reduce barrels. It's not actually jumped on this news, so it shows that actually the of doubt we're still in the bad area. We're out of the woods as of now. So for the second point, Iran sanction waivers. So the effects on Iranian output levels, is Iranian output levels going to jump? Because there's a lot of uncertainty. We have seen actually 700 from OPEC's report, right? But is it going to go down, or is it down slightly? So this is something that we want to take note of. The US continue, it's going to go up? It's rising, output levels going to go up. Now we are at 11.6 million barrels per day, which is hugely, it's very strong. So this one, check. These three key points, we can use it as forward guidance for the fourth quarter of 2018. Okay, from a technical, I just included this for those of you who might have a more bullish view, right? I would think that the WTI needs to break out of the 59.47 mark, the crucial zone, before a more neutral outlook. So for those of you who are fundamentally long, I would urge caution, of course. So so in a nutshell, right, for fourth quarter is a very strong persistent weakness. This can be more loss of confidence in the market, right? More than actually a huge fundamentals, actually. So moving on into a market overview, how do we actually see crude oil fundamentals into 2018? Okay, so 4 key points are, of course, the first will be a bit on global oil, because commodity is always the fundamental of the demand side of the curve. To talk about, which is OPEC plus against US. So will remain a supply narrative in 2019. And of course, moving forward, risks or geopolitical uncertainties and market risks, things that will hamper in the long run. Lastly, of course, we'll do a little technical for Q1 2019 prices go. Okay, so maybe I'll start just giving a run through this, right? So largely we've seen, right, IMF has actually forecasted for a 3.7% rate in 2018. There was sentiments, actually. So the reasons are, of course, is rising trade tensions we see, the effects of tighter monetary policies on the economy, mounting challenges as we see in emerging market currency rules, and so the significant fiscal stimulus boost, right, that has given a strong growth in the US markets, right, might start to slow as we have seen its effects in economic releases, retail home sales slow and soften. And also over in the EU, we have Brexit-related uncertainties that will move all the way into the first quarter, and Italy's issues, amongst others. So although we do see that on a positive note, we have India and China, although it's not doing so well, but I mean China, although it's softer conditions, they are putting measures to grow. Positive points in the Pacific that we see. But I think one key point to note overall on the economic growth for 2019, but there are a lot of structural and risk that is prevalent in. So this is something that we want to look out for, but I have stressed previously that it's a small, often than not, it's a supply narrative for oil prices. So we just want to pay attention to this, but this might cost the market for sure. Why do I say that I'm very optimistic for global oil? Right, overall it's for oil demand. Although there are softer conditions being projected, we are still seeing a 1.29 million barrel per day increase. But all this bear movement, there must be a reason for all this, right? So the bear movement is, of course, due to there's been 4 consecutive cuts and revision. So I think that for now, right, the sentiments are really weak, so it stems from all this negative headline tradings. And of course, more than that, is money managers have actually started to factor in all this risk and worries from global demand growth. So although this has actually, we feel demand growth will stay, but it is overall the uncertainties regarding global economic development is impacting market sentiment. If you look at this, right, as we look at world oil 2018, we can see that in the recent report, right, there's some weaknesses in Asia Pacific. I think there were some downward revisions that we see in China. Industrial production has flatlined, started to quite soft for more than but we have seen some good measures, I feel, from China as they have loosened economic policies. And this will largely help in our point of view, right, to support demand for the longer term. So in the Middle East, right, slow down in demand, so which, for example, significantly impacted by fuel substitution and transportational issues, actually. So that's why we see there's a downward revision in the Middle East. But overall, right, like countries like projecting growth rate still strong, which is recovering from the rupee crisis of 20. Well, I think although there's a slight revision, right, gentle revision downward, we are still optimistic for demand in 2018, and of course 2019. Right, we are still quite optimistic that actually the China's economy might actually flatline a bit, but overall, that with the Chinese government making measures trying to control we should be doing well for oil demand. And of course, as I just want to put for you to see China and US crude oil import data, right? It's still on the upward shift. There might be upward, it's on upward shift. The US, which is might have some softness, but that is also because the US produce quite a significant amount of oil. They are starting to use net exporter more than an importer, but still they represent a huge amount as the second US importer in the world. And China, of course, as well, there's some sharp fluctuations, but overall they're still doing well. There has not been a systemic shift, the trajectory in our viewpoint. Also note China and US import in the longer run, as both of them collectively import about 40% of the world's So yes, so as I move further into, I actually created this, right, to show you. For example, you see in 2017, actually a 13.6% shift in the WTI chart. WTI grew by 20.6% in market value. Originally, crude oil prices grew by 20% before we saw a 28% slam, and now it's actually in the red as well. So these are actually some of the risks, right, for oil demand that investors will do well to take note of. So eventually, essentially, the reason that why we're optimistic on oil demand is because whatever that has been said on rising risk, which is has in our viewpoint has really yet to substantially materialize. Although there is a chance, it's created weakened market confidence, but overall sustainable. But okay, back to what we're saying. These are 3 points that you want to take note of. Weak conditions, trading trade barrel, US and China, the impending G20 meeting. You want to determine what is the outcome, whether they can reach a settlement agreement, and to actually prevent rising trade barriers, global economic conditions. It's not good for oil prices as well. You can see supply chain disruptions have already happened in lieu of this trade protectionism. And so $250 billion for trade tariffs will do no good. So of course, we look emerging market currency rules. With this escalating US-China trade tensions, this will actually exacerbate the situation. So they have a system and rising debt levels. So this is also might weaken actually oil demand from emerging markets. So we want to pay close attention on how this actually pans out. So global central banks, the effects of tighter monetary policies, we are seeing one in December. Most probably, I think, if we go according to the dot plot plan, we see two more in 2019. I wish to see the effects of tighter monetary policies. So actually, for the first quarter, we are quite safe because it looks like they will do one more in June. So yeah, overall, right, we are still quite optimistic. The key point about the global oil supply. So we will share a bit more on why we think that oil prices remain a supply narrative and what are the KPIs actually affect oil prices in 2019. Okay, the first is okay. We've summarized I think 5 key points here. So these key points, I think these 5 key points will give you a good idea of what is going to happen in 2019, the first quarter. To actually give you a more, it's basically existing supply side risk against rising production levels. By rising production, I'm actually talking about the United States, and for supply side risks, I'm talking about OPEC and OPEC plus actually. So the first key point we will discuss later is of course on OPEC. So we want to see for OPEC plus 1 million barrels agree, will there be compliance on this issue? And next, you want to see from supply curve, right? You want to see OPEC, there's a persistent PLNA, Venezuela, Libya, Angola, and Nigeria. They have been blocked in the last 2 years by persistent production capacity troubles, which we'll discuss in depth later. And of course, the potential of a supply squeeze that is widely spoken about. But now it's more on the US sanction levels. So what is the outcome after the 5th? Will there be a sharp decline, or will the US actually look at sanctions? Fourth, of course, is the bearish factors, US production levels. How will actually up by mid? Will there be production level supply cuts by OPEC? This is actually quite key, quite pertinent now. So, and lastly, the top 3 crude oil producers, is it going to be a market share, or are they going to protect prices? So these are the 5 key points that you want to supply. Okay, we'll start with OPEC first. Okay, so currently we are seeing its oil price, its production levels has gone up. It's broken out of the 32.5 million barrels per day agreement, the original productions that was set in 2017. Because OPEC Plus was under pressure, for those who not in the second half of 2018, to increase production in lieu of an impending supply deficit of Iran. But of course, that's why we're in a bear market. So the suggestion now is to push prices, levels below 33 from existing levels. This is the amount that has been floated. But I think for those of you that you can use this indicator to look at OPEC production to see on a monthly basis, right, how prices are going. In our viewpoint, the cut and the prices continue to slide. Okay, compliance levels. For example, Bloomberg actually releases this just so that some of you might be interested, just in case. So Bloomberg actually includes all this. You can check the compliance level. So we can see actually from here, January 18, right, they have been largely compliant to the production limits. But it's just that there's been a shift from 107, right, all the way to 120. That's why you can see, right, after the meeting, there's been a range found relatively with the bull market in the first half, as you can see. Okay, we can see, so these are actually in the month of October, these are the key figures that are the key culprits that have been very compliant to the production. Saudi Arabia, UAE, Iraq, Russia, for a non-OPEC nation, they've not been very compliant as well. Okay, so if as we go in and we discuss the VNLA, right, so maybe I'll just share a bit of Venezuela. So with the imposition of US economic sanctions there's been a huge slide since 2015 to current levels. From our perspective, this is likely to continue as socio-economic issues continue to plague growth. In fact, we've seen refineries actually stop producing. So all this is likely to hamper production capacity and production growth in the long run. So from our perspective, this is likely to be supportive to oil prices. We don't see a recovery from Venezuela. Now, for the other trades, it's a little different. We are seeing now actually a marked increment from Libya and oil terminals and oil price production has. So this has also contributed to current term. But in the longer run, we feel that there's a persistence that's blogging Libya, Nigeria, and Angola. These three countries, especially, they have very civil issues, even pipeline structural issues, actually refinery issues from socio-economic. So the possibility and the potential of all this right from all these existing risks right materializing is still quite strong. So you want to pay attention to this. If there's a sharp shift, right, divergence in this, right, we might see a huge volatility in oil price. So we can see Angola, right, largely on the downtrend before moving up. This has also affected bearish conditions in the market as well. So Nigeria seemingly is hit 1.8 million barrels. Supposedly it's it looks. So this, although they are at quite a high level now as compared to the first half of 2018, this production supply side weakness is likely to persist and actually will keep investors on their toes. Okay, so just to show you OPEC production levels, for those who don't know, you can monthly report. So we can see also before the first quarter, second quarter, largely compliant below 1 million barrels. Then we saw a huge increment, in lieu of potential supply squeeze from Iran. So we can see key players have an increase is Saudi Arabia, UAE, Libya, and fourth biggest producer, but Iraq has slowed actually a bit, but you can see here there's a movement. So why do we think that actually, right, the OPEC control on this is because we see, right, largely the people who have increased Iraq. So all three of them actually have come together and said that they are collectively willing to cut production. So we feel that along Russia, right, although Russia has not expressed the same level of optimism and hasn't sought to assure the markets, we have seen that doesn't really want to come in the start. But once after the meeting, they are quite agreeable on the production cut, and with oil slamming down by 20%. We think that OPEC will move towards the direction and actually input production. So the next point, of course, is Iran. We can see as previous sanctions. I just wanted to put this chart to show how the effects of previous sanctions actually took off maybe more than about close to 1.5 to 2 million barrels in a quick span of time. So what we are seeing is that I think for Iran, definitely the shift is definitely on the downward decline, but how much is key. So in lieu of the exemptions, right, even for the first quarter, we do not expect them to drop like. So this is also a factor actually why we are not very super bullish about oil prices into the first quarter of 2019. For holding a longer term view, you see what happens actually if how firm be on Iran as we move further in 2018. Okay, I'll just spend 2-3 minutes, right, to discuss on the US market, right. So this, I think, also moving forward will be a key driver for oil prices, I think, all the way beyond 2019. So to give you a quick recap, right, on US shale. So US shale was developed with the improving of fracking abilities for oil producers. So we saw that this led to a huge increase and responsible for sharp in non-OPEC supply. So it has actually hit 11.6 million barrels per day. Seeks to lift legal restrictions, right? We see that this is going to be a significant challenge to OPEC. As OPEC Plus seeks to moderate oil prices through controlled production, right? the effects of increased US production actually hamper or imbalance. Actually hamper the balance of oil prices. So, 2019, you want to monitor the effects of US against OECD stockpile levels. So, okay, level, right, actually is on the upward trajectory. It's a flat line, right? You can see it's flat lining here in the third quarter. This is largely due to actually transportation issues. Transport issues. Yeah. So, but suddenly, and I think in Q4, there's a sharp increment in output levels to 11.6 million barrels. Initially, the projection was that by mid-2019, these issues would be resolved. Therefore, we do not expect for US shale to move as quickly as possible. But it looks like spending the pipeline has actually moved and work on the transportation and pipeline constraints have improved. So we want to monitor this. Should actually production levels keep climbing, quite a lot of trouble. It might actually happen for supply fundamentals. And also you can see, right, Baker Hughes crude oil rig count, a very good indicator, although this is a lagging indicator, but I think this is good for you to see in the bigger picture what happens. So as I spoke earlier on, right, the trajectory is relatively upwards, but over this area is flatlining in the third quarter. So originally this has contributed to bullish sentiments, but a spike up here, you see crude oil actually ramping up in the fourth quarter. This is cause for concern because transportational woes was expected to plague pipeline capacity to mid-2019. Now this might actually move and transpire faster than expected. So I think we want to be very cautious for now. Also, the third thing is that with all this increased production, right, we saw that US crude oil inventories have increased in consecutive weeks. So overall, I think the US production levels and all this rising supply seen have actually contributed to a very strong bear movement. So I think the whole story the whole narrative that we've been piecing together is still the same. Is OPEC and US the balance? What is going to come up? So how do we actually have a very good indicative here? As we speak on global inventories. So you want to see OECD commercial stockpile levels that I spoke before. I think this is the most indicative. So I actually created this slide, right, to actually give you just a viewpoint. We did a coefficient correlation measure against the WTI, right? There's actually a negative 8.7. So it shows that when price actually move in one direction, OECD stockpile levels move in 8 times, 9 out of 10 times. So this is actually the most accurate reflection. The target by OPEC Plus set 5-year average. Currently, although the oil production inventories have been increasing, but we are still at a good figure, 22 million barrels below the 5-year. So I think for a more macro form of fundamental viewpoint, you can use OECD commercial stockpile levels as a good indicator. Okay, so technical, I'm going to go one slide into market risk. So I've condensed actually 4 key points. What are the potential variables in oil prices beyond 2018? Create some volatility, towards this on the bull market. For example, the first you want to pay attention would be US-China. Escalation of trade barriers. China threatens to tax US petroleum product. This is possible risks of the economic slowdown for all this and its effect on the emerging market, right, is huge. So all this an escalation in protectionist policies is always bad for the global economy and in tandem fuel demand. So next we want to see the effects of policy. I think it has shown its effects in the I think investors are the effects of corporate earnings and all. So we want to see, as the US balances its fiscal stimulus policy against monetary policies on the global economy. For now, I would say we are still quite optimistic, but we are starting to experience effects of a softer economy. So we want to see if the Next, of course, is cooling domestic economy and financial deleveraging. China has actually started to loosen economic policies. So we hope this will also the markets, to move forward, at least maintain between the 6.5, 6.7 growth rate that China has wanted to impose on its GDP growth. But if the escalation of barrels from the first variable that we mentioned, it might actually derail its looser economic policies. Lastly, of course, emerging market currency rules. So, fragile financial system, should the currency continue to slide, right, and its debt is denominated as monetary policy is going up, this might create quite a pain for oil demand. So, as they struggle to pay dollar denominated. Okay, so lastly, before I think we move further, right, I'll go into technical and some market already. Okay, trading performance for crude oil in the first GC. Largely, we feel that this will be largely with geopolitical premiums initiated from US-Iran sanctions, which looks poised to end in the second quarter. Will be positive for oil prices. However, there is a structural shift in commodity curve, as I mentioned. It's now in contango, and very sharp movements, of course, the technical charts sell off. Also, rising US production levels look likely to negate all this positivity. So there's a lot of uncertainty actually, but so is that a modest recovery is likely to happen, transpire, but still range-bound with the conditions. So also we have seen from one point the hedge funds managed money has been cutting so much positions. Overall the sentiment is still a little optimistic. Net long positions, right, for money management ratio is still 3:1. But overall, you see the orange curve represents net short is going upwards. Well, net long positions actually is going downwards. It's a huge cut to record lows from previous long contracts. Okay, but I think technical analysis, I put actually a monthly candlestick chart to see. You can see at this point, right, it's a huge two huge candlesticks actually going down. Normally, if there's a term for some retracement or some correction, right, there's always these little wicks, some signs of weaknesses here. But actually, for oil, for this current terms, candlestick still very strong. It looks likely it's pushed through and broken the support level. It looks likely to go further downwards. Maybe not to 45, maybe to the key psychological level of 50. As we have. It's also broken actually the 100. It has actually also broken the EMA 200. Overall, although it's if you use oscillators, it looks very oversold, right? But we're still in bad territory. So what is likely to transpire from our view, in line with maybe it will hit the 50. Maybe that's where it will start to bounce, recover. Looks poised to actually move between 57.25 to 66.89, deliver maybe a more neutral outlook. For it to actually go up to a more, I think we have to break the 66.89 mark, which is actually quite a key resistance point from our point of view. Okay, so just here a market wrap, a snapshot of key variables, right, for quarter one. What are some of the want to look out for? Of course, the first, as we said, OPEC consumption and effects of output level cuts. Are they going to continue with this? How much and what is its effects? Are they going to be compliant? So all this is something you want to look out for. Key countries, I think, if you want to zoom in on, will be Saudi Arabia, Russia, Iraq, Iran, UAE, Venezuela. I think these are some of US shale oil rising production levels. This is going to break 12 million by this year. There's a risk going to jump exponentially. This is something that we also want to pay attention, as this might actually offset the positive effects of OPEC Plus. Global economic releases, you might use this as a gauge for the potential of weaker. Overall, we do not think that it will transpire that way, but we should expect for softer conditions, but still positive. US-Iran is the impact of exemptions on uranium output. Is the US going to be strong, hard line against Iran? Whether are they going to toughen sanctions? So these are 4 key points that you want to look out for. Okay, so maybe before I go into Q&A, I'll just talk a bit about product, right? So how trade crude oil products. How go about doing this? So, for example, to give you a view, express a view, you can use a contract, futures contract. CME Group NYMEX, right? What they do is that you can have a standard contract or mini contract. So a standard contract is 1,000 barrels, and mini contract is 500 barrels. In USD, minimum tick value is about 1 cent. So it's about really the initial. This is a leverage trading, right? You need an initial margin to start. So this is the amount, because it's the amount. Okay, 3,410 for standard, a half, of course, for the mini. Okay, just to let you know, oil contracts is this is the liquidity. So I just pulled out the contract on interest in trading volume has been very high. So it's a good amount, it's very liquid, highly liquid, and parallel, I think, for a commodity contract. Okay, so how do we actually trade crude oil futures? How does it look like, right? I've taken a source from CME, right? So, for example, you want to do a swing trade, you want to profit from upswing in WTI, you have a view. So you decide not to use stocks or ETF, you decide to go long as you want to go straight and trade the market. So, for example, you purchase 5 contracts of WTI in January that is due to expire in December, in this case. You have an initial margin of 11,250. So that is what you have to have installed before you can initiate the position. And the price of the crude is at 6.83. And the next day, assuming that the oil prices move up in your favor at 57.95, you take your current price and you subtract your initial price. And this is the profit of 1.12 per barrel. So your profit and loss at this point is 1.12 barrels times 1,000 barrels, which is 1 contract, as we shared earlier on, and 5 contracts times your initial profit. So this reflects your total profit. And how do you actually trade crude oil futures? Is that direct and straight to the point? You are speculating, right, on the pricing action and pricing. Okay, so for if you, because this at the end of the day, you actually advise you. But okay, so some people ask actually, why do we trade actually crude oil futures, right, instead of ETFs or stock? So I think I share a bit, right? The first is pricing action. Futures are always to the marketplace. So of course there are enhanced volatility, right, that is to be expected. But it does not naturally mean it in a bad way, as volatility response represents that it's actually very liquid, this contract. Next is direct play, market-based considerations. You can look at macroeconomic themes, form your views on this directly straight at itself, as compared to maybe if you do stocks, there are other variables like maybe the lastly, thirdly, we have executional costs. I think brokerage charges are significantly, lesser. There's some of the other investment products. Leverage trading, of course, it allows you for capital efficiencies. You can better utilize this on. You can actually start out with a sum, and it can actually view. But of course, the chances of it going south, or risk and return, is of course always moves in tandem. Larger risk, larger return; smaller risk, smaller returns. Market liquidity, diverse base of clients currently trading. So it's a good view of the market. Counterparty risk, of course, just there's always safeguards from clearing houses. So actually we seek counterparty risk, the investors' risk of a default. Ease of access, of course, this for oil futures is close to 24 hours trading. Actually, just an hour for markets to recalibrate. Okay, so before we end, I think we'll now go into a session.
Hi, thanks for staying with us through the to the end of the seminar. Okay, we have some questions here from Mr. Lim. Mr. E. Mr. Lee is asking you what position to take. Should he short, or is it the right moment to go the second half of 2019, or is it right now you can even take a long position? Any answer to that, Ben?
Okay, I think from a technical standpoint, right, it's actually okay. A lot of people actually have been deliberating whether has it been oversold, right? And my answer is yes, it has been severely oversold. But however, market sentiment, right, and market confidence is highly important at this point. And we have seen that it's very, very weak. If you just move back, right, to maybe 1 hour ago, right? Actually, they reacted actually, but there has been a weakening subsequently has moved down. The bullish short-term technical correction faced severe headwinds, and then after that it receded again. So overall, I would say like the larger trend. Okay, it seems to me like the bear movement is likely going to continue. There has been signs of weakness. So if you were to initiate a long position, I would urge caution, I would say, as a downside risk, right, is still very, very strong. What is likely to materialize now is maybe if it actually moves towards the upside, right, it's more, we hope that, no, sorry, let me just rephrase this. If you want to initiate a long position, right, at least some signs of a consolidation phase occurring for some range bound activities before it might actually opinion influences. So yes, I think, yeah, in your view, maybe speculate, maybe you might just want to take advantage of the retracement, then maybe, but of course all this is you have to look at and also retracement.
Okay, thanks, Ben. We have another question from Mr. Gary Lim. I think it's very similar to what the earlier attendee has. Maybe just Ben, if you have any other comments to add to this, how much lower will go? Will it go further down? And is it still going on the downside according to the scenario? How much? Maybe Mr. Lim is talking about maybe the term indicator.
Okay, as I said earlier on, right now actually we are resting, right? If you use the Fibonacci retracement levels as a good indicator, right? You realize that actually we are resting on the $55 mark. That is quite a strong support level. But if you see as well, right, there hasn't been any sign of some profit taking, where buying activities actually go up. So that's why actually we are still quite bearish on this, But it that will all the way to $50. That has been shown to be at. So although it's quite hard to digest, right, it's very disappointing for this. But I think from a technical perspective, this looks like where prices are heading. There hasn't been sign for weakness towards the downside from a technical perspective. So for short term, right, I would say it looks likely to move that way. These are the upcoming. So most likely, even if there's a likely going to be modest, very modest recovery. So even for upside, right, I think if oil prices might actually struggle to break 57 or even 59. For the key side, should it break 50, right, then it might actually 645. That's not likely for now. Yeah. So maybe right, for now, I think the downside is to 50 at least. Looks like.
Thanks, Ben. Okay, I think this answers Mr. You're welcome, Mr. Lim. Mr. Chan was asking, when is the next open? Does that have any impact on oil price?
Okay, the next meeting is on the 6th of December. So likely news will come 7. So of course, there's to be honest, markets actually most of the market moves before information. Now on, I think we are seeing that incline towards the production cuts. The idea is how significant. So how much confidence can the markets get from this? Obviously, the is how confident will be in to buy in for this. So I think overall, right, if you look at the meeting, right, what you want to take away and what you want to scrutinize is more of how much are they going to cut? Is Russia and Saudi Arabia really into the game? So this is a longer term thing that what of the cuts, or from all this, I think from this be able to gain some insight to see how much will they actually execute. But on the larger side of besides OPEC, right, you must also keep a close look on US production levels, because this is actually one of the part that I'm actually very concerned. My initial projection and estimates was that the shale line, the Permian Basin transportation issues, right, will continue to bog down production. A huge jump from 11.2 million barrels to 11.6 is very troubling. So this is actually, I think, besides the OPEC meeting, the US production level is what, as a consistent rise in US production level will offer production limits from OPEC plus.
All right. Thanks, Ben, and thank you for the questions. Thank you for staying with us till the end of the webinar. We hope that you found this webinar useful for trades and what positions to take in the coming year. Thank you, and we will we will upload this webinar within the next 3 days, if not by early next week. All of you will receive an email from us with the link to the YouTube, where you can recording. As for the slides, I think the speaker is comfortable to share, so we will enclose that slide in the email that we will send you. Thank you again, and good evening. Bye.
So yeah, for those with any general inquiries, feel free to email us at futures@phillip.com.sg. Telephone number is over there, and if you should, those of you who wish to inquire more, feel free to call us and make an appointment. It will be good to explain more. If you wish to adopt go ahead with an online link, it's at phillipfutures.com.sg/account. So please follow us on YouTube and Twitter, and we will do our best to assist. Much. Have a good evening.